Hey guys, how's it going? It's Andy from Magoo Investing. Happy Tuesday. In today's video, I wanted to switch things up. Based off of the current world events, talks about a potential recession, there's been a lot of negativity being talked about on social media and on news networks. In this video, I wanted to talk about some of the ways that you can benefit from this crazy time in the stock market. When I started writing this video last night, I was kind of expecting to wake up in the morning and see the market down. Kind of similar to how it's been pretty much every day for the past couple weeks. But I woke up this morning and there are two big news events that came out that have pushed the stock market up around 7% today. So before we get started, I want to talk about these two news events for the reasoning behind why the stock market is up a lot this morning, and it was very surprising to me. The first and main one is the fact that it appears like the stimulus bill in Washington is actually going to go through. I talked about this on yesterday's video. On Sunday, it appeared like the stimulus bill might go through. It did not, and there seemed to be a lot of conflict between the Democrats and the Republicans to get this bill to go through. And it appears like this morning that it's actually going to happen. It hasn't officially happened yet, but there's a lot of talk this morning on how talks are getting very close. What this means is that the American people are going to be getting a lot of help, and in addition, major corporations are going to get bailed out if they need it. And the big sector that's been benefiting from this are the airline stocks. I've been very vocal about how I dislike the airline stocks for a long-term investment, but this morning this news pushed all of these airline stocks up a lot. Stuff like Spirit Airlines, ticker symbol SAVE, was up 37%, and the rest of the airline stocks were up between 20 and 30%, which is an incredible day for them. But when you put this into account for how far they've fallen in the past month, this is just kind of a little bit of a rebound, and I expect them to fall further. The other big news is that Trump announced that they're going to be using the Defense Production Act for the first time to try to fight this pandemic of coronavirus. Seems like it's only going to be implementing around 60,000 test kits around the world to try to figure out where all this spread is coming from and try to contain it as much as possible. And from what I've seen, seems like a lot of the discussion online is people are happy that this is being used, but they wish it had been, one, done sooner, and two, included some other things that people need in the medical field. So we're going to have to wait to see how effective this is in the upcoming weeks. So as I mentioned, I've been seeing a lot of negativity, especially around the stock market with how fast everything has fallen. And so in today's video, I wanted to talk about 3 ways that you can take advantage of this fall in the stock market. And I'm going to talk about 3 ways that you can make money as the stock market continues to fall. Obviously, all 3 of these options are not guaranteed ways to make money, but based off of the way the stock market's been going for the past month, I think it's a pretty good bet to say that the stock market should continue to fall further. But before we get started, I got to say that I'm not a licensed financial advisor, and I highly recommend talking to a professional, someone that can find you the best place to put your money going forward. In addition, I really appreciate if you hit that like and subscribe button, as it would help my channel out a lot. The first and most obvious way that I feel like most people haven't been really talking about this to make money as the stock market falls is by shorting the stock market. There's 2 main ways that you can short the stock market, and some of them are easier than others. The first one I want to talk about is the conventional way of shorting the stock market. Basically what happens is you go to your broker, you borrow shares from them, immediately sell them for the money with the expectation that you're going to have to give the shares back to the broker at some given time. The way you make money off of this is you're selling it at the beginning, say for $100, so you get $100, and you expect that the price of whatever stock that you borrowed is going to go down. So if it goes down to, say, $50, you're pocketing $50 in profit because the broker wants the shares back. They don't need to know how much you sold it for and bought it for. So as long as you give them the shares back, plus some interest, that's how you make money from shorting the stock market. For people like myself with smaller funds, or maybe if you're still using stuff like Robinhood, this is not something that you're going to be able to do. You're going to have to be using big time brokers. The reason that you need this is because you have to have shares available for you to borrow from your broker. And stuff like Robinhood isn't going to have that type of availability of shares. This also comes with the caveat that there are a lot of companies that you cannot short just because your broker does not own enough shares where they feel comfortable lending them out. And so mainly it's the blue chip stocks, the very popular stocks, that they have the ability for you to short it. And for stuff like really volatile stuff, likely you're not going to be able to do that. But there are still ways for people like myself that were on Robinhood for a long time. Last summer, I was feeling very hesitant about the market. There was a lot of news events about the Federal Reserve cutting rates, which is really interesting because when I look at it, they cut rates from 2.4 to 2.1, and now we're down to 0. So in hindsight, it wasn't that big of a move. But at that point, it seemed really large, and there was a lot of trade tensions with China. And during that time, I talked on this channel about how I was shorting the market. And the way I was doing that was I was buying shares of the ETF SQQQ, which is a 3 times weighted ETF that follows the NASDAQ. So if the NASDAQ goes down 1%, SQQQ goes up 3%. So as the stock market goes down, you make 3 times whatever the movement on the NASDAQ. So during that summer, I bought shares of SQQQ in addition to the shares that I already had. And the reason I did that is because I wanted to hedge my portfolio. Hedging is the idea of protecting yourself from downside risk, and you can do that in a lot of different ways. But in this case, it's the idea that if the stock market goes down, you're making money on your SQQQ as the rest of your portfolio goes down and kind of balances it out. So at that point, I was talking on this channel how I had around 50% of my portfolio short and 50% long. I was just kind of in a holding pattern. I wanted to see what the market was going to do. I wanted to still have shares in the market, but I didn't feel confident enough to pick a direction. So I was kind of in a holding pattern. I ended up breaking even and everything was totally fine. And so I'd highly recommend not going full short because this is something that I had to learn the hard way. Christmas 2 years ago of 2018, I thought the market was going to fall. We were deep in the trade war and things were not looking really good. I had shorted the market for pretty much the entirety of December and I made a lot of money. However, the day after Christmas, if people remember, was the best day of the year where the stock market jumped 5%. The reason this happened, there was talks that the trade war was going to stop for a while, and this pushed the stock market up a lot. And I slept in that day because it was the day after Christmas, and the stock market went up 5%, which means that I lost 15% instantly. So I'd highly recommend not shorting the stock market completely, or at least if you do, don't do it as the 3 times weighted ETF because that's a lot of damage if you pick the wrong direction. Also, long-term, holding stuff like SQQ or long-term shorts are probably not a great idea because, as I've talked about on this channel a lot, on average the stock market goes up 10%. Obviously that's not going to be the case this year, but for a long-term play, the trend of the stock market is to go up, so shorting yourself puts yourself at a disadvantage right off the bat. So short-term shorting, good. Long-term shorting, not as great. The second way that you can make money during the stock market fall is by using options. And for people that haven't used options in the past, it kind of seems like a foreign language. There's calls, there's put, there's all these different straddles, strangles, stuff you can do. It's a really complex way of trading the stock market. And during a time like this where the market just continues to fall, people have a lot more time on their hands. I'd highly recommend doing some more research on options because it's just a fascinating way to play the stock market. At this point, I'm still not 100% confident in all the different ways of playing options, but I'm going to try to give a crash course in the upcoming weeks about my favorite ways to trade options. And so I'm going to give a kind of breakdown of what an option is. Basically, the idea is that you're buying or selling a contract to sell or buy a stock at a certain price by a certain day. For this example, I'm going to talk about calls and talking about buying a call. So if I buy a call for a stock at $100 by May 1st, that means that if the stock goes up to $100 before May 1st, I have the right to buy 100 shares of that stock at $100 from that person. So if the stock goes up to $120, I'm making $20 profit right off the bat. One of the most beneficial things about using options is that you don't need a lot of capital to make things happen. The premiums for buying these options are relatively cheap compared to buying a full lot of shares. The problem is right now the market has been incredibly volatile. I've talked about in the past that one of the ways of determining the overall market volatility is by looking at the VIX, which quantifies how volatile the S&P 500 option prices have been. And so as volatility has increased, the price for these options have gone up because the stock market is moving significantly more than it has been in the past. So these options are become very expensive. So during a time like this, probably the only option strategy I would consider using is the covered call. Covered calls are a great way to lower your average cost on a company that you intend to hold for a long-term position. And so for this example, I want to use my Twitter shares because Twitter is a company that I really believe in. I think it's incredibly undervalued and I intend to hold it for at least a couple years. And for this scenario, let's pretend I have 100 shares instead of the 10 that I actually have. So my current trade on Twitter is that my average price is at around $30 and the current price is $26. So what I wanted to do is sell a call against my shares of Twitter, which would mean selling a call means that if it goes up to a certain price, I agree to sell my shares of Twitter to someone else for that given price. But you might ask, what is the benefit of that? The whole thing is the premium. As you sell the call, you're pocketing the premium immediately. So if the call does not get exercised and it just expires completely worthless, you're pocketing that premium. So for a time like now where I think everyone can kind of agree that we're probably not near the bottom for the stock market, selling a covered call against your position is probably a decent play. I'm sure there's going to be people that really disagree with me saying there's better ways to make money during a time like this, but this is how I would personally do it. So when I go and open up the options menu on TD Ameritrade, you can see all these different numbers. And for someone that hasn't looked at something like this before, it can be really daunting. But the thing I want to focus on is the $27 strike price for May 1st, which is 38 days away. So during these 38 days, I have the potential of selling my shares to someone else for $27.50. And you might ask, why would I want to do that if my current price is at $30? And the whole reason is the premium. With $1.44 in premium, this basically drops my average price from $30 to $28.50. And so if this does get exercised, I'm going to be taking a loss for sure of a dollar per share, which is going to be a bummer, but it's not that bad. But I'm betting on the fact that I can think that the market is going to continue to fall and this option is not going to be actually used and it's going to expire worthless. So if the market continues to fall and it doesn't reach that $27.50 by May 1st, what happens is that call is going to expire worthless. I continue to hold my shares, I get to pocket the premium, and I can do anything I want with that money. I can buy more shares of Twitter to lower my average price. I can buy other shares. I can buy different options if I really want to. Or I can just pocket the cash and hold on to it for a rainy day. You just have so many options with selling options because you get to pocket that premium. The disclaimer for this is a really big simplification of how options work. They're a really complex thing, and if people don't really know what they're doing and they try to use these really complex option chains and they don't know what they're doing, it's a really easy way to lose money. So before you actually go out and try this for yourself, I highly recommend doing some paper trading, doing a lot of research, and trying to figure out the best strategy that works for you. Similarly to trading stocks where there's a million different ways to do it, if you look at the different ways of buying and selling options, there's so many different strategies you can use, and I highly recommend starting with the really simple ones of just buying calls and puts and selling cash covered calls and puts. During a time like this where a lot of people have some time on their hands, I think people should do a lot more research on options. One, because I think they're really interesting to look at because you don't need a lot of capital to buy them and you can make a lot of money if things go the way you expect them to. And two, I just don't think that people utilize them as much as they probably should. And the third and final way to make money as the stock market continues to fall is by dollar cost averaging. And before you get all upset and say, oh, that's not how you make money right now. I want money right now. Yeah, this is not the type of channel that would talk about really short-term making money strategies. The whole point of Magoo Investing is investing. It's for long-term financial gains. And dollar cost averaging is probably the best way to take advantage of the stock market continuing to fall. This is the idea that as the stock market falls, you're slowly adding on to the positions that you intend to hold for a long time to lower the average cost of your shares. So going back to my portfolio, I want to take a look at Twitter again because I mentioned it's my favorite stock and I think it's incredibly undervalued. My current share price is at $30. The current price is at $26. And if I bought a couple shares right now, it would lower my average price, meaning that my break-even point is lower than it was in the past. But the whole idea of dollar cost averaging is that you don't do it all at once. For people that think this is the bottom, sure, you can go all in right now and add on to your position, maybe even double your position size. But the idea of slowly adding to your position is as the stock market continues to fall, you're slowly lowering your average cost. And if the stock market continues to jump like it did today, you're going to be slowly adding and you're not going to miss the bottom. The whole idea of adding on the way down and the way up is that you continue to lower your price and you get to see as much information about how the stock market's been moving as possible. So at this point, I have not started my dollar cost averaging. I'm getting pretty close. I'm waiting probably a couple more weeks to see the overall damage to the economy that the coronavirus has done, and then I'm going to slowly start adding to my positions that I want to hold for a long-term position. But I don't think we're at that point yet. But I'm starting to get ready. I'm looking at stocks I want to buy. I want to look at the stocks I want to add to for dollar cost averaging, and I'm trying to plan out my future plays. Overall, I've just been seeing so much negativity about the stock market and the current state of the world, and it's very valid. There's a lot of horrible things going on right now, but I thought I'd give 3 ways that you can make money during this really tough time in the stock market because it just seems like a lot of people are sitting there and just taking a lot of losses when there are ways you can make money in the stock market if you have learned enough about how the stock market works and the different ways that you can play the market. So let me know what you thought about my 3 options, which one was your favorite, and if you want me to go in depth further on stuff like options in the future. Thanks for watching, stay inside, and I'll see you in the next video.